Be informed capital gains tax deferral. The Enterprise Investment Scheme, or EIS, offers attractive capital gains tax treatment with potential for tax-free gains and the ability to defer gains made on other investments until the shares in the EIS are sold. Any gains an investor made in the 3 years before allotting shares in an EIS, or future gains made up to 12 months after shares are allotted, can be deferred. You could be forgiven for thinking that deferring tax has no real benefit. However, in many cases, a tax deferred is a tax saved. If you defer a gain into an EIS, the gain is treated as though it was made in the tax year in which you dispose of the EIS shares. This applies whether you dispose of them at a profit or a loss, although with a loss, you can offset it against the realised gain. If you defer capital gains tax or CGT with an EIS investment and then die while still owning the shares, the deferred capital gains tax will then fall away because you do not pay CGT when you die. If the shares qualify for business relief, there will be no inheritance tax to pay either. But you don't have to die to get a total CGT saving. Every year you are entitled to some tax-free gains, currently £11,700. If you spread your EIS investments across a portfolio, they should exit over a period of time, probably starting 3 years after your initial investment and finishing after around 8 years. The gains will come back into play each year. However, the investor benefits from their annual CGT allowance, which means that they may not have to pay any tax on the realised deferred gains. In this example, where the deferred gain was £60,000 spread across 30 investments, allowing for inflation of the annual allowance, the investor will probably make a complete saving of the CGT. The investor may be able to reinvest any of the realised deferred gains in a new EIS and still not have to pay the tax until later, if at all. You do need to be aware that tax rates have a habit of changing, which can be both good and bad. In the 2015 to 2016 tax year, the rate of CGT fell from 28% to 20% for non-residential property gains. Those people that realised a gain back then may still be able to defer it into an EIS. At the same time, you could end up paying more tax if the investor did not have enough annual allowance when the gain comes back into play if the rates went up. So, clients who have capital gains tax liabilities may get significantly more benefit from the tax incentives associated with EIS, and advisors should be looking through their client portfolios to identify those clients and discuss the merits of an EIS investment with them.